Hello, welcome back again. Looks like you enjoyed the video that I made about 5 undervalued stocks, and this is why I'm making part 2, taking a look at companies and suggesting 5 more companies that are undervalued. Now, bear in mind that this kind of video takes a lot of work to make. I have analyzed a lot of stocks, and so if you are here and you enjoy this kind of content, please leave a like, that really helps. And also gives me a little bit of a thanks for all the work I'm doing here. So thank you. And if you're not a subscriber, please subscribe. There's a lot of content coming your way, and you're gonna be gaining access to this tool pretty soon, in about a couple of months, where I'm going to release it, and you'll be the first to know. So, what's going on here? I'm using the discounted cash flow model, and I have analyzed the stocks much more than this. But I want to make this video concise. I don't want it to be like 30 minutes. And so I'm going to be using the discounted cash flow model. You can, of course, take a look at the financials of every company that I'm analyzing here. But a couple of the companies that I will be analyzing, I will be showing a few more things because it makes sense. So let's start and you will see what I mean. I'm pretty sure some of these companies you won't really be expecting. But more than likely, you do expect Alphabet if you're a cautious investor and if you're analyzing stocks. You will see here that Alphabet is pretty much a gold mine. They are actually a cash flow machine. And I have used these values based and coming derived from averages here. I've used 12, 14, and 16, which is well below their current revenue growth. This is a 5-year cash flow model, discounted cash flow model. So you'll see that the least that they have done is 12% in 2020, and so I went with 12 for my low. The net income margin is 17, 19, and 21. What I've used, again, we're well above, and the free cash flow margin 90, 95, and 100. You can see the breakdown here, a little bit of the odd one out here, but overall they're doing about 90 to 100. And this is the company that I really like to see. This kind of financials is my thing. I absolutely love it because it's steady, it's concise, it makes sense. It's all every year it's the same thing, and so I know what to expect, and I can much easier project what the company is gonna be doing. And if you hit calculate, and I've done that already, you will see that the max price to pay right now for the company is 2,800 at the lowest estimates, and the current price is 2830. So this is actually more than the current price, and it's actually a green. So at any scenario, right now Google is a buy, and at the high scenario we could be paying as much as 4,600. This is the high scenario, which I don't think it's very high really. These values I think have a lot of meaning here, and they can definitely become true. So again, remember that this is the max price to pay today in order to be getting a 13% annual return based on the mathematics, based on the financials the company is achieving. Let's move on to the next one. And this is going to be Berkshire Hathaway. Some of you may expect this, and you may want to be buying BRKA if you can afford it. But the least expensive one is the Berkshire Hathaway B. And I like this company because even though it's a conglomerate and has a lot of different investments, I know who is behind it, and I know that their style of investment or of investing really matches mine. And so you will see here that I have also used pretty conservative estimates based on what they are doing here. And again, this is another company that has similar years, like similar net income margin, for instance. Look at this, it's 17 to 25. Very very easy to forecast. And so the free cash flow margin, there has been a little bit of a discrepancy because they have had this amazing year over here. But this is why I went with lower values, 50, 60, and 70. This is the very nice thing about the tool. You can really play with a lot of different values, and you can analyze and see what the company has been doing, and kind of derive your averages based on this. And so I think 50, 60, and 70 makes a lot of sense here. And you could of course go a little bit lower if you really want to, but I think I'm fine with this kind of free cash flow margin for the next 5 years. And again, I'm always using a 13% just because I want to compare these stocks with the same potential gain, against the same potential gain. And so you will see here that the current price is sitting at $358, while the max price to pay for the low estimates here is 436, and you see the high ones. So even with these estimates, which I think they are fairly low, and even with a free cash flow margin of 50% here, we're still getting a low of which is well above the current price really. It's what, like 20 to 30% or something, 20% maybe. So the next one, and yeah, Berkshire Hathaway is definitely a company that I'm actually looking to add to my portfolio. And the next one is going to be JD.com. Again, it's kind of hard to find bargain prices in the US market, although 4 of the 5 stocks that I'm suggesting here are from the US market. But this one I had to include because I think it's an interesting opportunity and a good value here. Again, you will see that I'm using relatively conservative estimates here, pretty conservative estimates, and a 135 net income margin here. My 5 may be a little bit of a stretch, but I just wanted to see what we can get out of 5, because this is a growing company. And free cash flow margin that is again all over the place, and you can see that here. And I did go with 80, 90, and 100 because they do have some years that are amazing and some years that are terrible. So I did go with something that is a little bit average and in between. So this company has a little bit more risk. Bear that in mind. This has happened for sure because of the latest problems with China and the US also. That plays a role. It is a company, again, that has a little bit more risk. It's an e-commerce company, but I did want to examine the company using a free cash flow margin that makes sense and some relatively conservative growth estimates based on what the company has been doing so far. And so when I did that, I'm getting a low of 21, which is much lower than the current price. So this is expensive, but for the medium and high ones, this is probably fair. So I would still urge some caution about JD.com. It's an interesting potential play and maybe acquiring a little bit, but it wouldn't be my top priority. I would add it to my shortlist and maybe wait. Maybe if it goes to 50, it's gonna be a little bit better even, or if you got it at 50. but I think that it's a potentially interesting play, just because of the growth and potential of the company, and even at some weird projections here and some weird financial aspects, estimates that the company has been doing. I still see that for medium and high projections, the company is still pretty or undervalued or fairly valued in some situations. So again, I think there is some potential here. You may want to take a little bit more risk and accumulate a little bit of JD.com right now, because I feel like they could grow much more than what they have right now. And again, even with these weird values here and weird averages in some cases, you're still getting nice projection results. So I would add this to my shortlist. So the next one is going to be from the financial sector, and it's going to be Goldman Sachs. And you'll see that I'm not using a discounted cash flow model here. I haven't actually taken you to that. And there's a reason for that. When we're talking about banks and financial services, they handle a lot of debt. And if you try to work on a discounted cash flow model, your results are going to be super skewed. Because again, the company's financials and operations are about debt, handling debt. And so free cash flow has to do with operations. And if debt is part of your operations, then it's going to be massively skewed. And as I mentioned in previous videos, what I do like to see much more than the actual discounted cash flow model for companies like Goldman Sachs is actually taking a look at the key metrics of the company, and especially the price to book ratio. And you will see it as an X here, because by default the tool will tell you, will give you a check mark if it's below 1, but it's practically 1. And you will see here that it used to be 1.3 also at some point, and also even lower, but still at 1. Whenever a company or a bank of that sort has a price to book ratio of near 1, I generally speaking like it because it's selling at book value. So it's selling at assets value pretty much. And so I feel it is a good opportunity to get a little bit, especially since it's also decreasing its outstanding shares. It buys back shares. And so it has pretty great key metrics here. It has good stuff are happening here. Good return on equity, revenue growth and all that. And so it also pays some dividend, and it's a pretty hefty dividend compared to the payout ratio, which is low. And so I feel like the company is doing well, and I could potentially see myself adding it to my portfolio. So I wanted to definitely suggest Goldman Sachs as a very interesting company here. The next one and the last one for this video is going to be MKS Instruments from the industrial sector, a company that you may not have expected here. And this one, you will see that I used again some relatively conservative projections here and estimates about what the company is going to be doing. And again, I liked the averages here. Good net income margins and pretty much the same every year. Same free cash flow margins, again, pretty much similar every year. And so if you go with relatively conservative estimates based on what the company has been doing, you're getting projection results that are for the medium projections, for the medium estimates really, are actually below the current price, actually above the current price, which means that the current price is actually great. It's actually would definitely fit our scenario here. And high estimates of 232. And the other thing, because this kind of company may not be very well known to people, I kind of wanted to also show you the stock analysis here for the company. And a P/E ratio of 15.7, a price to free cash flow ratio of 15.6, a little bit of extra shares, but that's not very concerning because it's very little. It's like 2%, so I wouldn't be too concerned about that. And good revenue growth, good income growth, net income growth, good free cash flow growth, and pretty great gross profit margins and quite good net income margins as well. So I like this company, paying a little bit of dividend as well. It's a company that I could definitely see myself adding to a portfolio, good return on equity. So not much to not really like about this company, and this is why I wanted to suggest it. And excuse me for this new data that you see here. I'm adding some more functionality here to the charts, and I forgot to remove it for the video. So hopefully you enjoyed this one. This was the second part of my suggestion about 5 new companies and stocks that are, I think, pretty undervalued right now and potentially interesting purchases. Now, some of them are better, some of them are worse. But again, in this current market, many companies, many well-known companies that you potentially even think that they are undervalued are actually overvalued. I have examined many companies in order to make a video of this sort. Companies including, for instance, Starbucks, which you could think that it's undervalued, but it's not. It's actually overvalued. So I'm trying to give you as much value as possible here by examining some of the companies that I feel can have a future potential for growing and making you the most money. So of course you need to do your own due diligence and not just blindly buy anything. I'm just suggesting here what I would buy myself, but again, what you buy is definitely your own decision at the very end. Remember that. So thank you for watching this video. Hope you found it enjoyable and kind of gave you some ideas. If you did like it, please leave a like, and again, subscribe. Be around. There's gonna be a lot more things coming your way. And thank you for watching this one. If you haven't watched the previous video that I made about this, which was 5 more stocks, it was the first one to potentially own, take a look at this one. I'm adding a link here. So thank you for watching this, and I'll see you soon. Bye bye.